All right, welcome fellow investors. Look, today, November 10th, 2025, isn't about some explosive, flashy headline. No emergency rate hikes here. Instead, what we're seeing is a really crucial macro restructuring. The European Central Bank, or ECB, is quietly tightening the screws on liquidity, and it's completely changing the rules of the game for crypto.
Okay, so here's how we're going to break it down. First, we'll look at the ECB's squeeze and what it really means for liquidity. Then, we'll get into the new rules of the game. We're talking climate risk and the rise of real-world assets. And finally, we'll lay out a trader's playbook for how to navigate this tight market. Let's dive in.
First up, Section 1, the ECB's squeeze. We need to understand the pressure that's building on macro liquidity. Okay, so there's this key concept we need to get our heads around. Monetary policy transmission. Sounds complicated, right? But it's actually simple. It's just the process of a central bank's decision, like a rate hike, actually making its way into the real economy, affecting things like your mortgage. And a new report from the ECB today basically confirms that their recent rate hikes, they are working exactly as planned. Now check this out. This number right here, 0.9, that is the whole story. This means that the rate hikes have almost completely passed through to what really matters, household mortgage costs. This isn't some academic exercise anymore. This is proof that liquidity is actively being pulled out of the system, right now.
So what's the bottom line for us in crypto? Well, it's simple. Assets like Bitcoin and Ethereum, they absolutely thrive on a sea of cheap, abundant liquidity. That's what fuels those explosive moves. So when that liquidity gets tighter, it acts like a brake. It puts this short-term negative pressure on all risk assets, making those huge growth spurts much, much harder to come by.
And if you want to know what the ECB is thinking, just look at this quote from their vice president. Central bank independence is the key to keeping inflation under control. This is them telling us loud and clear that their number one job is fighting inflation. They're not here to prop up markets, period. So, what does this mean for the market in the immediate future, say the next 24 to 48 hours? Well, we're not expecting some massive crash. The impact is more likely neutral to slightly negative. Expect to see Bitcoin and Ethereum kind of go sideways, consolidating and testing those key support levels as the market just digests all this new pressure.
All right, moving on to Section 2, the new rules. Because this isn't just about liquidity, it's about a whole new game being shaped by climate risk, real-world assets, and institutional DeFi.
Okay, this right here is a huge shift. The ECB is now directly integrating climate and ESG risks into its credit and collateral framework. What does that mean in plain English? They're telling banks to start prioritizing lending to companies and assets that have strong climate performance. This is a massive deal.
So this creates a really interesting knock-on effect. You have this new regulation forcing banks to assess climate risk. This, in turn, creates a massive market need for tools that offer transparency, compliance, and real-time monitoring. And guess what? This is a huge opportunity for crypto. This is exactly what institutional DeFi and real-world assets are built for, providing that verifiable, transparent solution.
And what this is leading to is a great divide, a real professionalization of the crypto space. You're going to see a clear split. The winners? They'll be the projects with strong fundamentals, a focus on RWA, and a solid compliance strategy. They'll attract the capital. And the losers? Well, those will be the highly speculative projects with no real financial use case. They are going to face some serious headwinds. And make no mistake, this isn't just a European thing. We're seeing a coordinated push from regulators all over the world. You've got the ECB on climate risk, you've got the CFTC in the US focusing on tokenized collateral and stablecoins, and you've got the Fed working on stablecoin frameworks. The whole world is moving in this direction.
Okay, so with this complex new environment in mind, how in the world should we be trading? Let's get into the trader's playbook and break down a solid strategy.
Right, so the most likely scenario here is market consolidation. It's basically a giant tug of war. On one side, you have institutional demand pulling prices up, but on the other side, you have this withdrawal of macro liquidity pulling them right back down. That's the perfect recipe for a market that just moves sideways.
So to get an edge in this kind of market, there are two key metrics you've got to watch. First, on-chain institutional behavior. You need to be tracking those large CQ wallets on CryptoQuant or Glassnode. Are they quietly buying? If they are, that suggests support will hold. Second, keep an eye on the EUR/USD exchange rate. A strengthening euro means a weaker dollar, and a weaker dollar is historically a really positive sign for Bitcoin.
So here's a 3-step risk management strategy to keep you safe. Number 1, prioritize the blue chips. Stick with Bitcoin, Ethereum, and those vetted RWA and institutional DeFi projects we talked about. Number 2, use on-chain data. Don't just look at the price chart. You need to understand where the real money is flowing. And number 3, and this is absolutely critical, limit your leverage. With tight liquidity and regulators watching, high leverage is just asking to get liquidated.
So what's the big takeaway from all of this? It's that the crypto market is maturing. It's growing up. Regulation isn't some far-off boogeyman anymore. It's a primary force that is actively shaping the future growth of this industry.
All right, so what should be on your radar for tomorrow, November 11th? You absolutely need to be watching for any regulatory updates from the CFTC and SEC over in the US. Also, keep track of any progress on the digital euros preparation phase. And of course, keep those daily on-chain reports from Glassnode and CryptoQuant open to watch for any whale accumulation.
And all this leaves us with the biggest question of all, right? Is this liquidity squeeze from the ECB going to be enough to completely stall the crypto rally? Or is the wave of institutional money that's coming in just too powerful to stop? What do you think? And which altcoins in that RWA space do you think are going to be the big winners? Let me know what you think down in the comments. We'll be watching this very, very closely. Talk to you in the next one.